Good evening. This is the Elliott wave update for the S&P 500 and the NASDAQ 100 for Sunday, February the 5th, 2023. Friday's expiration was exceptional. In fact, the whole day was exceptional to me, primarily from how the day began. Again, on Friday morning, pre-market, we got the latest employment situation data. And it was a surprise. It was a big surprise, actually. The consensus was expecting the addition of about 255,000 new jobs, people being added to payrolls. And that number actually came in higher than 500,000. So it was a pretty big surprise. Then, and to be interpreted via the Fed would suggest that it's going directly opposite of what they actually need about right now, to display or just to convey that they really are serious about bringing down inflation, taming it, and meeting their goal of returning inflation to about 2%. Now, again, no misunderstandings. I'm very pleased that there are 500,000 plus people that now have jobs, that are being paid, that are likely also have benefits, which will include insurance and maybe some other things. But in any case, the people are working. It is a good thing. Now, in terms of exactly when it's happening, on how it's and what's paying for it, or a great deal of it, is inflationary. That part of the $1.7 trillion stimulus that got pumped into the system, into the monetary system last month, 800 billion of it goes to the infrastructure package, which of course is to begin the process of repairing the bridges, repairing the roadways, building out the infrastructure of our country, which has been sorely needing repair. And so to really improve and to build out the electric grid, to improve and build out the broadband, to improve and help repair hundreds of miles of railroad tracks, and improving how we move cargo across the country and people across the country into other places. These things all cost a great deal of money. That's been denied and put down as things being adequate. Until we start getting bridge failures and we start getting other things. And so the federal government needs to step in. That's what we pay taxes for, not just to have this group of people sit in Washington and bitch, moan, and complain about everything and just not do anything and not create any policy and not improve the economic conditions, not improve the operation of the country, et cetera. They all say that's what they want to do, but we get very little results. So, to have people going back to work is a good thing. It is inflationary, unfortunately, because of where it's coming and how it's being paid for. Nonetheless, I'm grateful for the people that got jobs, and they are now being able to care for themselves, their families, etc. Now, what it does to the marketplace is now being reflected in. And if you did not watch my weekly update, which is the big picture update, you're going to notice the first thing that, yep, I have changed the labeling, but it does not change really at all the near-term picture of what I am expecting. I'm expecting a decline, and now it's going to come in the form of a C wave, an intermediate C wave, versus prior the intermediate third wave. Now, both the C wave and the third wave are going to carry the same characteristics, the same type personalities in terms of how waves react and what they do. So that does not change. This changing this to an X from the primary B does suggest, it doesn't change the outcome of what's going to happen. But what it does suggest is that we've not reached that primary A wave level yet, because I've got an ABC, XABC. And if I just take a peek at the weekly, you'll see it coming off of that high. So to think that this is all the correction, and I'm talking like even from there, even from the COVID low up to here, which is nothing but pump money into the system, trillions of dollars into the monetary system. And it's got to, talk about clearing the books, lightening the load. That's really the Fed's task. They're just not really laying it out to us because there's many different things that they can do to achieve the same result. So we got to kind of let them do their work and trust that they're doing it properly. And how it affects the market, we really kind of have to look at that the economic future or the economic near future for the United States and actually for the globe is not looking all that great. And so adjustments need to be made. Denial's not one of them. So understanding that it's going to happen, it just allows us to trade. And unfortunately, the market is sometimes paying attention to what's happening and sometimes is not. So therefore, we unfortunately still need to leave open the potential that the S&P will go up again and reach above the highs that we've seen thus far, which are about 4209, I think was the high, 8.5, 9, somewhere in there. And we still can make one more new high before this C wave is complete. And that's why you're noticing here, I haven't put a 5 up there. Because right now the market did, Globex did kind of gap down a little bit, but now, the S&P is only down 1050 and sitting right at the daily 4, not just the hourly, but the daily 4. If I bring it down to the hourly chart, it's going to look a little bit more strange. It is producing a slight new low. It's kind of a weird pattern because right now it just kind of looks like maybe 1, 2, and now we're coming off 1 again, and now it should either drop and basically we can run some quick fibs just trying to see where downside should be able to find some form. And right now it's 4118. So we've already seen a low at 4130, so it's not that much. It's only 12 S&P dollars more before this leg equals that leg, and that could send the market again higher. So if you remember last week, a lot of this discussion really does not can be cast off as like, oh, the Fed's going to take this action, or some other government agency is going to take this action, or this is what's going to happen economically. I think that scenario, those pictures, those are pretty much set. The Fed has deliberately told us exactly what their goal is and what their methodology is going to be, and to expect several more interest rate hikes. So what the market then decides to do with that turns into something else. So again, I'm just, the information that I'm presenting truly is not trying to develop a bullish or bearish posture or a picture. It is just basically, since we associate moving higher with bullish, moving lower with bearish, that's why the word gets associated with the moves. So right now, it does appear, and we need to continue to allow for a little bit of a drop down. We find support of 4118, then 4100, a clear break below that, and then a break below the 200 period moving average. That's on the hourly, which sits at 4090, 4084. Then we're starting to work into 1, 2, 3, 4, 5, and then I can get my first 5 down on an hourly, and then I will put, like right now, nothing. I will put the 5, and then I will put the minor wave C. Actually, is it a minor? I believe it is. I got to take it up, my poor brain. Yes, a minor C, and then an intermediate B wave. So what comes next, folks, is an intermediate C wave down. Characteristics, like I just said, very similar to a third. So again, when I'm just changing the label, and it just makes that primary degree move still incomplete, and that would be the first leg down. So, and I'm going with it right now because it does not take away that I would be expecting a B wave rally. It's just not going to be of the same intensity as a cycle degree B wave. It's a primary degree B wave. But I want to tell you, in all intents and purposes, wherever we end up, even if it's 3,200 down to 3,000 or somewhere there or just below, a move from there back up to where we are That's a pretty good move. And it's very tradable, extremely tradable. So we're going to leave it right there. Now, if I need to kind of put back on some additional upside, what I'm thinking where we could go as far as the wave C, then I'm still going to use these. I'm going to go and we're going to put up the larger for the entire C wave. Okay. Then I'm going to go down and I'm going to go back to the hourly chart. And first thing I'm going to do is I am going to take this one off because that is going to produce, that's the downside. And I'm not looking for that right now. I'm looking for the upside if this thing decides to turn around. Like stops here at 41.18 and then turns and starts to head up. In that case, it would be 1, 2, 3, 4. And then we're looking for a 5. If it starts dropping down here, we're breaking below the 4. This is going to be it. So if we're now looking for what we can get to the upside, I'm using, oops, don't want that one. I'm going to be using extensions. And we're going to go there to the top of 3 to the bottom of 4. Come on. So again, we've already been above 4,200. We've been 42.12 continues to be resistance. And they have 42.35, 42.62. Again, on the backdrop of seriously, reality will take over. Interest rates are going to go up. Stop paying so much. Now, a lot of that, folks, continues to roll around. What are they going to do in Tesla? What are they going to do in Meta? What are they going to do in Apple? Is reality going to hit? We don't know yet. And so what are they doing in response? They buy it. Because anticipation is that there will continue to be demand. And how do I arrive at that? We go back out. I'm telling you, it is options. It is options related. Here are Fridays. So a lot of things got rolled out. And what got rolled out? 200. That's what got rolled out. And both put-wise and call-wise. So coming in tomorrow, that is going to be a wall that's going to sit there. It's going to be like, yep, that's what we're looking at. That's where all the positions are sitting. And when we go beyond that, then we have to consider 210. And we have 207. So we got some odd layers in between that it could come into play. But again, the big one right now to start the week, 200. Notice what? Friday's close was 189 or 190. Then they bought it up. So my thought process is this will increase. So will the premium and drive it. Now, taking a look at Meta. These are all heavy hitters here in the NASDAQ. I mean, in the S&P and also in the NASDAQ. What do we got here? 20, 47, 200. So yet again, they just rolled it out a week. They both went for it on Friday. Didn't work. They rolled it out. So as long as that stays in play, we leave open the potential that this could go and do another pop before, again, reality hits and they go, up, that's too high. Boom, we're willing to sell it here. And, things become, lined up for it to happen. So back out. Let's take a look here to bring it into focus. So we got the upside. We've got a little bit of downside. So again, ABC, these are upside numbers. And now we have even the internal for just the fifth wave. Should that be the case? A 5 of 5. Well, actually, I got the 5. I can do one more. We can make this really, I hate to say it, you can cloud the issue because now we have 1, 2, and this would be a 3. So I can go from here to here. And I'm just going to say, let's give it the benefit of the doubt and say it gets down to there, that 18 level. All right, so here we got again. We're all lining up, 42.12. Got a bigger one stacking up in there, and then our next one is 42.29, 42.33, 40.41. And all I'm doing, folks, is just adding layer upon layer. If we're going to go up, that's what it's got to get through. If it's going to go up here, it's got to get through. There's a lot that has to happen before you're going to start tootling around at 43. there is resistance all the way up based on the pattern, based on Fibonacci relationships. And I'll tell you right off the bat, a lot of algorithms are geared up that way. So going over to the NASDAQ real quick here. Same story. I've only left it at a 5. And then we also here on the NASDAQ have changed. It's an X, an A, and we're looking for an intermediate B wave here. It did gap. It's now still holding lower, but you can see on the daily, it also is holding above the 4. So we have to leave open the potential that we got one more shot at it. Now, this would give us a downside look. If we're looking for a C wave and that really does complete it and we start to drop, you're looking sub 10,000, but that might just then complete primary A and we rally from there. Otherwise, we can go sub 10,000 and then put in a primary B wave rally. So all things are possible right now, but ultimately I am looking for that downside move. Now, how high and where can we go still yet? If we're not done with wave B, then we're looking at, number one, retracements. If I'm going to consider this wave A, I'm looking for wave B, they are retracements, just like we did for the minor wave 2. And we're looking that we're already above 70.5. No, we've actually dropped back. So 12,780 becomes resistance. Above 12,950, we really have to consider that we start to find not very much. So I'm going to be looking then in here. And so if that's going to be the 5th wave that's going to continue with inside, then I'm going to go from here to here to here. And I forgot and left them as, hold on one second. I got to get rid of that one. I got to change this over to extensions. Go there, there, to there. And basically what we're looking at, we're going to find resistance in a lot of different areas, but right now it's at 12,780, 12,830, 12,963, which is going to take us to a slight new high, and then 13,088 to 13,100 for that throw over. Again, Tesla, Apple, Meta, if they continue the folly based on going for a strike price, leave it to the financial media because they will have to go scrape and scour to find some story that's going to support a bullish stance on any of those stocks. And so, whatever. I think that what we need to just continue to look at is our fibs, the pattern from here. It would have to be ABC. This would be the 4 with inside this 5th wave. 1, 2, 3, 4, and then a 5th. So I can't really been starting to look for anything too magnanimous. But from here, now this would be this larger 5th wave. So this one's still being in progress. Comes to 100% at 13,415, and that would be of the 3rd wave. Well, that's pretty big. That's a pretty sizable move. Can it do it? Sure. Can it do it in an unrealistic atmosphere? Sure, it can. We've seen it. Right now, we're kind of getting into an area where it's like, nope, we're not extremely overbought, and we're definitely not oversold right at this minute. So that's kind of what I'm going to be looking for. They now fit. Please do listen to the big picture update that I made, because I talk about the bonds, I talk about gold, I talk about the dollar. They all now seem to be in alignment with one another in terms of the moves that they're making and how they all seem to fit for the equity markets to decline, gold and silver to continue to decline, the dollar to continue to go up, and interest rates, the interest rates themselves, the yields should now go up. Very near term, but the pattern does allow for it. And then we resume where interest rates go back down for a little bit. It's all about the move that the 30-year and the others are making in terms of Elliott wave. Okay, I'm going to leave it right there. Our next update will be on Monday, February the 6th.